Good morning. Good morning, guys. This is Teacher Polite, and today I just wanted to look at the basic accounting terms. Okay, so let's get started. So firstly, we just want to define what is accounting. There are so many definitions and different ways of defining accounting, but this is the one that I just chose for us to use. So accounting is a systematic way of recording business transactions so that the state of affairs is fully revealed. So what we are saying there is that accounting refers to a way of recording business transactions so that uh, we can reveal the state of affairs of the business. Okay, so now I think the question that is going to rise is, what is a transaction then? So a transaction involves the exchange of goods and services for money. So if we exchange goods and services for money, that is a transaction. So whenever there is a buyer and a seller, they meet together to engage into buying and selling, then that's a transaction. So these transactions, they can either be cash or credit transactions. So if it's a cash transaction, it involves the client paying immediately, which means that a person gets into a shop, like for example, and then they buy paying by cash. Or maybe it depends with the type and nature of the business. Then a credit transaction is when the customer pays later for the goods that you provide for them or for the services. So that is what it means. Then let's move on to define other terms such as sales. So when we talk of sales, we are talking about the goods that are sold. Goods sold, those are sales. Then purchases, we are talking about goods that were bought for resale. So let's take, for example, you're running a business, a clothing business, and then you buy clothes from the manufacturer to sell them. Those are what we call purchases. Then sales returns or returns inwards. There are certain circumstances whereby we sell goods to our customers, and then later on the customers they return the goods to us. So we call those when sales returns or sales or returns inwards. And these are the goods that are returned by customers. Then purchases returns, we are talking about the goods that we return to suppliers as a business. We bought goods from suppliers, and then maybe later on we discovered that the goods were damaged or the goods were not in a good condition, so we return them. Those are purchases returns. Sometimes they also refer to them as returns outwards. Then inventory or stock. So when we talk of inventory or stock, we're talking about goods that are waiting for sale. So we buy goods. We don't want a situation whereby a customer comes, they want goods, but then we cannot provide. So what we do, we buy goods in advance so that when a customer comes, we're able to provide them. So those goods that we have for resale are called inventory. Okay, then next we want to talk about debtors or accounts receivables. So when we talk of debtors customers who owe the business money for goods or services provided on credit. So if we provide goods or services on credit to customers, then since they have not yet paid us, they are what you call debtors. Then let's move on to the next part. We're talking about creditors. So creditors are people or organizations which are owed money by the business for goods and services provided on credit. So we got goods or we were provided services by an organization or people, but we haven't paid them as yet. So we call them creditors. Okay, then let's talk of drawings. So drawings, we are talking about money or goods withdrawn by the owner of the business for personal use. So if the owner of the business takes goods for personal use, then that is what we call drawing. Then capital is the money used to start a business. That is capital. And then when we talk of expenses, these are costs of running the business on a daily basis. So the costs that we incur in running the business on a daily basis are what you call expenses. Like, for example, we can just say, e.g., we have things like maybe our rent, let's say rent, we have our wages, we have things like water and electricity. These things, you need them on a daily basis, so they are expenses of the business. Okay, let's talk about gross profits. So gross profits, we are talking about sales minus cost of sales. So the goods that you sold minus the cost of sales is what we refer to as gross profit. So cost of sales, how do we get our cost of sales? We say opening stock plus purchases minus closing stock. Then net profit is the difference between gross profit and total expenses. So at the end of the month or year, we'll say our sales minus cost of sales, then we find gross profit, and then we'll say gross profit minus total expenses so that we can get the net profit. Okay, then let's define what we call assets. So when we talk of assets, we are talking about items of value that are owned by the business or possessions of the business. So we are going to look at assets in details and also the liabilities. So let's look at the definition for liabilities. So we are saying liabilities are the amounts owed by the business to other people or organizations. So like liabilities, the money that you owe to other people for goods or services provided on credit to you. So now let's look at assets in detail and discuss what are assets. So assets already we defined, we say these are items that are owned by the business. So we have two types of assets that we have. Number one being fixed assets. So when we talk of fixed assets, we are talking about assets that are bought with the intention of keeping them and using them in the business for a long period of time. And these assets like they cannot be easily converted into cash. It takes longer than maybe a year for you to convert them into cash. So we have land and buildings, vehicles, equipment. These are the fixed assets that we have. There are so many fixed assets. I just wrote these ones as examples. Then we have number two type of assets. These are current assets. So when you talk of current assets, they are assets that can be easily converted into cash, at least in the like in the next 12 months. So like we have things like stock or inventory, debtors, cash, and bank. So these items, they can easily be converted into cash. Then let's talk about liabilities. So liabilities, we say they are amounts owed by the business to other parties. So we have also two types of liabilities. Number one being current liabilities. So current liabilities, they are the amounts that are owed by the business to other parties, which have to be paid within a year. So current liabilities have to be paid within a year. And like, for example, a bank overdraft, creditors, those are our current liabilities. And then non-current liabilities, these are liabilities that have to be paid or they have to be repaid over a long period of time. So it takes a long period of time for you to repay them. So maybe you pay them after 2 years, after 3, 4, 5, going upwards, even up to 20 years. So that is what we are talking about. So Generally, these are the definitions that I had for you today. See you in the next video when we're going to be looking at the accounting cycle. Thank you.